Today we're going to look at a CEF, a closed-end fund, which could be the best way to invest now so that when it comes to retiring, you have a healthy fixed income. If you're new to the channel here, guys, then please consider heading down there and subscribing so you don't miss out on any future content that I bring out. And while you're down there, give it a little like as well. Or of course, wait until you've enjoyed the video in its entirety and liked it, and then like it. Pop a comment down below as well what you think, what your thoughts are on CEF, high yielding ETFs, whether you're getting into any of these, whether they've been on your radar for a little while, which ones have been on your radar and what you might be doing with them. It'd be great to hear from you and have a conversation about it because it's genuinely interesting. And it'd be great to share your experiences with other people in the comments as well and just let people know what you're getting into and what your income plays are going to be. It's been a week or so since I've uploaded any videos, just been super busy and needed a week's break really. So I'm going to get back to it with a dividend income video, which is my favorite way of investing and is a lot of people's favorite way of investing. Certainly not as fun or as glamorous as earning big returns from your penny stocks and your growth stocks. It's a little bit safer and you get an income from it as well. You get almost guaranteed return on your capital. So today we're gonna have a look at a closed-end fund, which could be the very best way of getting your money into the market long term from now to earn fixed income. I own some of this stock we're going to have a look at. This isn't a stock analysis, although I will look at an article that analyzes it a little bit. This is purely going to be an exercise of looking at eventually how much you need to put in to this stock to be earning a good level of income on retirement. This stock is a closed-end fund rather than one of your normal ETFs. A closed-end fund is more actively managed, whereas an ETF would typically mirror and mimic an existing index like the S&P 500. So I own an ETF, Vanguard VEO, which is the S&P 500 ETF. It mimics the S&P 500. A closed-end fund is slightly different in the sense that it is actively managed. The fund manager will buy and sell securities as and when they feel appropriate and therefore can earn a bit more of an income. These have much higher, not always, but typically much higher dividend yields, and investors would consider them more of an income play. We're not looking at huge growth here, and in actual fact, the one I'm looking at, even in a 10-year span, hasn't really grown, but has consistently paid a very high dividend. So it's a relatively safe income play. So a very different style of investing, but one that you might want to have a look at. It might be interesting to you to get those almost guaranteed, slightly less risky dividends coming in. And it's a very high dividend as well. If you relied on just one sole REIT, mortgage REIT, or anything like that for that dividend coming in, you're putting all your eggs in one basket. At least with an actively managed fund, they spread the money across securities for you and minimize risk a little bit as well. These guys and CEFs and ETFs and high yielding ETFs I'm going to be going into quite a lot. I said in one of my last videos, if you didn't catch it, I'll ping it up there. It was Apple. I think my last video was Apple, so long ago. I stated how you could get rich buying Apple just from their average yearly return over the last 10-20 years. My portfolio is going into Apple at the moment, ETFs and income funds in the form of CEFs, and I'm going to be choosing a particular company to be diversifying in these CEFs as well. Right, way too much waffle, way too many acronyms. I'm a bit lost myself. So we'll get into the computer, have a look at the article first, and then we'll have a little look at the CEF itself. So here we are in the portfolio as always, and I'm going to go straight into it. So this CEF that I'm talking about is run by PIMCO. It is called the PIMCO Corporate and Income Opportunity Fund. It's right here where my cursor is. I have 173 shares of it. In total, just over $3,000 in value. It's up 20%, which is great. And it offers an as of right now, I think it's an 8.67 or 8.76% yield. If that's all you need to know about this, and it's a monthly payer as well. So that's on a monthly basis, not the yield, that's yearly, but it's given to you on a monthly basis, broken down to 12. So that's all you need to know. You can skip the rest of the video, but if you want to know a bit more about it and have a look at this article I've got on it, then we'll take a deeper dive into that as well. So let's quickly have a look at this. I'll have a look at the chart quickly for you. Scroll out of this. So here's the chart of it. The little white dot you can see there is where I got in. That's the moment I did get in. So I got in down here, which is great, but I have averaged up a little bit since then. That's when I got in, but it just brings the level up to kind of here, but still up in the fund. It's doing okay this year. It's like 9.5% up for the year, I think. It's not designed for capital gains. It's not designed for growth, although if that does happen, that's great. It's more designed for income. It's more of an income play. So whereas your ETFs are going to give you 1.5, maybe up to 2%. Typically, some will do a bit more. This one's a much higher yield at 8 point something, and PIMCO do other funds, high income funds and high yielding ones that offer over 9%. But this is one we're going to have a look at today. So I've got it on screen here. PTY is the ticker symbol, PIMCO Corporate and Income Opportunity Fund. As I said, 9.44% so far this year, but watch this quickly. This is a demonstration of how this is not a growth play, or they're not really geared towards capital gains. If I go 5 year, fantastic, 40% up. If I go 10 year, it's actually down. And if I go max, you know, it hasn't grown a great deal. We have our peaks and troughs. It's remained pretty stable. But there's some interesting things I want to show you. So we've got an expense ratio of 1.3%. We have a yield of 8.69%. So I was slightly wrong there. And if we go into dividends, which is the very reason you'd be purchasing this, and we go into dividend history up to 10 years, and we've had consistent payments. And actually, let's head into the article now and I'll show you, because it's actually more than that. So here it is, it's on Seeking Alpha. So PIMCO Corporate and Income Opportunity Fund. You can go on and read this. It's one of the latest ones. It was released February 19th. So we're just going to go over the basics here. So funds forward current yield is 8.67%. So it's different obviously in Seeking Alpha. It's changed since this article came out. The fund has been consistently paying dividends since its inception in 2002. So we've had consistent dividends for the last 19 years. And this is purely income, as you saw from the graph a second ago. We've not had a great deal of capital growth here. So this is an interesting one to be investing in if you just want that income coming in on a monthly basis. Fantastic option, fantastic fund, closed-end fund, income fund for retirement potentially. Or, as I said, if you just want that income coming in. So have a look at this yourself. I'm just going to scroll down to the bits that I've kind of highlighted. I thought it was just quite interesting to have a look at. Its 3-year dividend compound average growth rate is 0.15%, and its 5-year compound average growth rate is 0.37%. So therefore, investors buying it now should not expect any volatility in the dividend payout going forward. This is good and bad. They're not increasing their dividend by a great deal on a yearly basis at all. 5-year compound average growth rate is 0.37%. So it's nothing to even really talk about. But that also means that it's probably not going to come down from its 8.67, 8.69% dividend yield. If anything, there may be a little growth there in the dividend payouts. So the fact that there's no volatility in it, that's a good thing if you just want the income. If you're looking for growth, if you're looking for value plays, you're looking for those deals, you're not going to get that here. You're just going to get good, solid income. I'll scroll down to this bit here, which is talking about the other funds that are around in PIMCO's armory. So we've got PTY's yield is 8.67%, which is lower than RCS's at 9%, and PHK is the high income one at 9.94%. The fund has outperformed them by delivering price gains of 12% in the last 3 years and 50% in the last 5 years. So obviously that's not true based on what Seeking Alpha has already told us, but we're talking 40% in 5 years. I still don't think you need to be looking at this as for capital gains, but it's interesting that they point that out. Typically, any income investor buys a fund for the long term, and PTY beats all its PIMCO peers if we account for both long-term price momentum and forward dividend yields. What that's basically saying is actually it's beaten all the PIMCO CEFs as well in growth. As I said, you know, full disclosure, I'm not saying that this is a growth play by any means, just an income play. The fact is, it's a massively high dividend yield. They're geared up for income. It's an actively managed fund, and they've been paying dividends for the last 19 years. So some of you might turn around and say, well, why don't you buy something like Altria Group that's been paying dividends for 50 years and has got an equally impressive dividend yield, I think, around 8%-ish. Well, yeah, you can put all your eggs in one basket, and then the same thing could happen to Altria Group that happened to Luckin Coffee. As I said, I'm sure you all know that story by now. In fact, I might do a video on it so you all absolutely know what happened with Luckin Coffee. But the fact is, you're diversifying and you're still getting that income and you're getting an actively managed fund. So that's it in Secret Alpha, that's the article. So go ahead and read that. If you go to PIMCO's website here, we've got all their funds here. So go to the US site, head on to investments, we've got all the mutual funds listed here, so you can have a look at all of those. And then if you go back to investments here, we've got all the ETFs here as well. So again, I'm not going to go through these in great detail. The website's there, you can take a look at all of them there. You can take a look at which ones you like, which ones are paying a reasonable yield if you're looking for income, which ones have consistently paid for the longest, which ones seem like the safest ones to be getting into and do it yourself. But I wanted to open your eyes into the idea of income investing and the possibility of getting a nice position built up in a few income funds, CEFs, that are actively managed to consistently return that kind of money to their shareholders in disbursements to see you out potentially to retirement. So let's take a calculator here and just work out, if you put all your money into this one fund, what you need to be getting into the fund to earn a reasonable living in retirement. Let's say, for example, you need $2,000, pounds, whatever it might be, in retirement. You paid down all your debts, you paid your mortgage off. This is just to cover a few bills and some fun money. At £2,000 a month, you're going to need £24,000 a year. Now I'm going to do this a little bit of a backwards way, but we've got £24,000 we need on a yearly basis. So let's take 100% divided by the yield, 8.69. We now need to take 24,000 and times it by 11.5. So 11.5 times 24,000 equals 276. This is all very rough, don't forget. 276,000 is what you would need in this fund to achieve your £2,000 a month. And don't forget, the main thing here is it will be paid on a monthly basis. Let's just back that up, the maths up. So 276 times 8.69% equals 23,984. So it's not exact because there was decimal places I didn't use, but that's what you're going to need. You're going to need 276,000 pounds or dollars to get that pounds or dollars on a monthly basis. So take that same calculation and apply it to any amount that you need to be living on a monthly basis. Take that calculation and apply the same thing to any other funds out there. Take the high income PIMCO one that was yielding 9.94, work out how much you're going to need in that fund to be able to live on that when you retire. Just thought I'd get a video like this out there, open people's eyes to a different form of investing. If you've not heard of closed-end funds, they're an interesting prospect for investors, so could possibly form a good portion of your portfolio moving forward. There we are. Hopefully that has maybe opened some eyes. Maybe you don't agree with any of that and you're going to keep investing in the way you're investing. That's absolutely fine. There's no right or wrong way of investing. Just put that out there. Well, it's probably a wrong way, but there's no particular right way. People have their different ways of doing it. People diversify quite a lot throughout this. I certainly do as well. You know, you've seen my portfolio: growth, dividend, income, the aristocrats and kings of the dividend world, and obviously these penny stocks now that I'm getting into, and growth stocks that are far more interesting. So there's no right or wrong to this. So hopefully this has opened some of your eyes into a different way of investing. We're not going to be getting capital growth here. It's just going to be an income play, and you're going to be getting that income on a monthly basis usually, which again is nice for retirement as well. So hopefully you've enjoyed that video. Hopefully you've gained something from that video. If you have and you want to see more, don't forget to subscribe. If you have enjoyed the video, then don't forget to like the video down there, because it really helps the channel out, gets this message out to more people. More people might want to be investing in this way, and we need to get that out there to those people. So on that note, I'll catch you guys in the next video. See you later.